And then we launched this platform called the Arab Business Angels Network. When we translated angel back then, this was 2005, to Arabic, they thought we were a religious organization. So the journey for a founder is to raise money until he exits. And typically you start raising money from initially your parents, then your friends, then hopefully an angel, somebody who likes you, who understands your sector, and who's in it not just for the money, but he adds a lot of value.
Yeah.
And then hopefully you end up getting money from institutional money, which is what we do at MEVP.
Yeah,
right?
start
Firms,
with venture capital
now,
with higher risk appetite.
Yes, now, all the stuff is under private equity because we're still investing in private companies. So VC is a subset of private equity at the end of the day. And then as you grow, you end up doing your Series A, your Series B, bigger funds, maybe international funds. We've done that at MEVP. We've actually been able to raise about $1.6 billion for our companies. There's something called leveraged buyouts. And leveraged buyouts can be done on public companies or on private companies. And there are things called management buyouts, where management wants a new type of shareholder. They go find a private equity firm that will go and buy their shareholders, but keep them to lead this new company. So there are a lot of variations on the same thing.
That is the VC model, right? It's make 100 bets and hope that one pays
Yes.
off.
However, we don't do an American model. I'll explain to you why.
Okay.
In the US, you can lose 90% of your portfolio. And then one company does an IPO and you can return multiples of the funds.
Yeah.
We do not have that option here.
Yeah, explain that.
Okay, so our upside, short of an IPO, is probably a 5x, 6x. If your upside in a trade sale is a 5x, 6x, you cannot lose 90% of your portfolio, you never make money. It's just math. And people who don't understand that don't understand the business. So we take much less risk here than in the US. The US is the land of specialization. Here is the land of jack of all trades.
Hello, and welcome to the Lucidity Insights podcast, The Perfect Pitch. I'm very excited today because I have Rabih Curry with me, who is the partner and chief exit officer at MEVP, Middle East Venture Partners, one of the oldest, most established VC firms here in Dubai. Welcome.
Thank you for having me, Erica.
I'm really excited. We were just talking off camera here for a moment of why I'm excited to have you here on the podcast. One, well, I've also heard this because you're an OG of the VC space, and people do call you the VC Yoda, or the Yoda of VC, I suppose. But also, when I look at your background, it's fascinating to me. So one of the storylines we always get is, how did you, as an investor, end up in that investment seat across from us? What makes you you? And I found out that you were a structural engineer for 8+ years before you entered into the finance space. Mm. So before we get into all of the ins and outs of the VC space here, what it means to be a chief exit officer, helping out startups in the region find that exit, I want to take a step down memory lane. Take you back. You graduated from AUB in engineering, and then you went to UC Berkeley in California for structural engineering. Then I read somewhere that you were doing these seismic retrofits of like nuclear plants and the San Francisco auditorium and all of these things. Take me back to that time. Did you always want to, were you a passionate engineer? Did you think that you wanted to get into finance? How did this transition happen?
Okay. So, being a VC, I'm supposed to portray that, my life has been scripted since I was 17.
Right.
Absolutely not true. And this actually will, and I'll reflect on that. This also mimics how much volatility and pivots we go through some of our investments.
Yeah.
It's very easy in hindsight to talk about what I call salvation history, right? So, I grew up, I grew up in Kuwait. I was actually born in Kuwait, so I know the Gulf quite well.
Okay.
And then my parents, who are Lebanese, moved back to Lebanon just before the civil war started. And then we moved back to Kuwait, and then we moved back to Lebanon.
Okay.
And then ended up graduating from International College, which is one of the important high schools, American high schools in Beirut. And then the American University of Beirut, that is actually 6 years older than Berkeley. So it's a very old institution.
Interesting.
Studied engineering because I didn't have a choice. My father's an engineer. My grandfather's an engineer. So engineering was what I had to do.
Typical Arab upbringing.
Yes. So you're either a doctor.
Options?
No.
Yeah.
Yeah, but typically you're either a doctor, attorney, or engineer.
Absolutely.
Right? So now I obviously, had some, some capabilities in engineering, in math and in physics. So, and then finished AUB and then went to Berkeley to actually get my PhD, and got my master's, got into the PhD program, and then never finished my PhD. And to this day, even though I have now an MBA from Columbia, right? This is the second part of my career. My father still has not forgiven me.
That you could have been a doctor of engineering.
Yes, but also, I mean, people forget that we work in finance, etc. But the nerds rule the world. Okay, I mean, between AI, between all these big tech companies, it's not finance. So I sold out early.
You don't consider yourself a nerd?
Yes, definitely.
You do or you don't?
Yes, I am a nerd.
You are? Yeah. Okay, but your dad wanted the PhD to prove it.
Yes. Doctor in the Middle East, very important.
Of course. Okay. And so you're doing these structural engineering projects. Were you passionate in it? Was it your
Yes. However, let me also clarify. Structural engineering, people tend to think we're building buildings.
Yeah.
I specialize at Berkeley in a sector called computational mechanics, which is very computer-driven, how we model buildings in a computer.
This is before CAD?
It was at the edge of CAD-CAM,
okay.
But we couldn't run them on PCs. We used to run them. We used to rent time on something called the Boeing computer systems. They used to have Cray computers. Mm-hmm. So you'd send these batches and anyway, this is ancient history. But I always focused on the computer side of structural engineering.
Okay.
Berkeley had also a unique distinction compared to Stanford, for example, or MIT, where this computational mechanics actually sat in civil engineering, not in mechanical engineering.
Okay.
So, for example, Berkeley has another interesting program called Naval Architecture. This is basically for people from navies to learn how to build ships.
Okay.
Berkeley has this very distinctive program. So these people used to take their CAD-CAM, finite element, computational mechanics courses with us in civil engineering.
Okay. So you're doing this and I can see that first thread of the technology element embedded in there. What made you shift and go, okay, I'm going to go do an MBA at Columbia?
Well, it's a succession of curves in life.
Yeah.
So I was supposed to get my PhD and go back and work with my father in Saudi Arabia. But then the first Gulf War happened. So that sort of created a whole hiatus into what I was going to do and whether I would go back home.
Okay.
And then I ended up working through one of the professors at Berkeley on a project that was sponsored by the Department of Defense, the U.S. Department of Defense. And that project just was very, very interesting and took 4 years.
Interesting.
And I was not able to finish my PhD because I got distracted on that project.
Okay.
And unfortunately, that project, now it's not secretive, but it was fairly top secret. So
Can you speak into it now?
No, I can now.
Okay.
I can now. So the Department of Defense has several nuclear sites across the U.S. There's a very important site called the Hanford nuclear site. This is in Washington State. It's next to a small town called Pasco on an Indian reservation.
Okay.
This is where they processed the fuel for one of the atomic bombs during World War II.
Oh, wow.
There were two bombs, Fat Man and Little Boy. Mm-hmm. One was enriched uranium, one was plutonium. The enriched uranium, the enrichment was done at Berkeley in the cyclotron. And then the fuel was moved to New Mexico, Alamogordo, where they assembled the bombs. Mm-hmm. The plutonium was actually processed at Hanford.
Okay.
And then they moved the fuel, and then they mothballed that building in, 1945, 44.
Okay.
So then in the 80s, if you remember, I think in the 80s, we had Chernobyl disaster.
Yeah.
And people understood that you could have a nuclear disaster, very localized. And, the Russians had to, back then the Soviet Union, had to vacate that area. But then you had this radioactive fallout, radioactive dust that blew into Sweden, into Norway, etc. So there was this highly radioactive mothballed building sitting in the middle of nowhere in Washington. And Washington, like California, is very seismic. You have earthquakes.
Yeah.
It's called the Circle of Fire. It goes around the Pacific Plate, goes into Japan.
Japanese, I understand.
Exactly. So, and sometimes this is driven in the U.S. by people. Somebody sued the government saying, this thing might collapse, and we might have the radioactive dust that might, be blown into Seattle, Vancouver, etc.
Right.
And one of my professors was working with a firm in San Francisco that specialized in this work for the Department of Defense.
Interesting.
And I ended up working on this building, trying to prove that this building will not fall down in a major earthquake. Okay. Proving it through computer simulation without having to go and do any work on the building, because the building is highly radioactive. You could not work on it without respirators, etc.
Interesting.
So that ended up taking 4 years.
Okay.
And we proved that the building will not collapse.
Interesting. Yeah. So I understand you get captivated by this project, and then you fall in love with engineering and stick with it.
And then I felt it was a bit too late to get back to my PhD. My father had sort of left Saudi Arabia, so that position that was there was not there anymore.
Okay.
And I ended up working as a structural engineer in San Francisco.
Okay.
But
and
working
where these buildings came into play.
And because we were experts working on these big nuclear power plants, nuclear, facilities, we ended up working on some of the key aspects, key buildings in San Francisco, especially after the Loma Prieta earthquake.
Yeah.
If you remember.
Yes.
I was there during the earthquake. Yeah.
Okay. Yeah. Okay.
So San Francisco City Hall, for example, almost collapsed.
So this is really important work as an engineer, as someone with your computational background. What made you go, okay, it's time for an MBA?
So I end up basically the interesting projects ended.
Okay.
We didn't have any more government work on the big, because they were not building anything new anymore.
Yeah.
And if it's new, they would build it well.
Yeah.
So there were no more government work. And remember, the Soviet Union collapsed. The whole sort of nuclear deterrence changed a bit.
Yeah, the appetite for nuclear also started to dry up. Yep.
And then in the U.S., because we didn't only work in California, all the interesting big projects were already fixed. And I wasn't very interested in doing some very mundane engineering work.
So it was the first time in your career where you thought, okay, I need to stay relevant and I need to pivot.
No, I wanted to have fun and relax. And that's why I went and did my MBA.
Well, surprisingly, not to anyone who's done an MBA, but that is what people go do an MBA for, isn't it?
Yes, and I think that also the allure of Columbia being in New York.
Yeah.
I like New York a lot as a city, so...
And so while you did it, and right after, you actually took on a role as VP of American Bank and their securities division.
It was Bank of America Securities.
Sorry, Bank of America Securities. Tell me, how was this transition? Was it at Columbia that you realized?
No, it was actually, again, another, curve in life.
Yeah.
So when I was at Columbia, I was actually the vice president of the Management Consulting Association.
Okay.
So I was supposed to become a management consultant.
Okay.
But one of my professors at Columbia, she's still there at Columbia. She was an adjunct professor who was also a director at JP Morgan in their M&A department.
Okay.
Moved and got promoted to MD at Bank of America Securities because they were building a new investment bank. And she sort of hired me.
And this is why people, it's so important. Everyone you meet, you have no idea what connects. And it really is like life is a people business.
Yes.
People follow people. So you followed her because you really loved working with her.
And pissed off my father again.
Of course. Because now this is the nail in the coffin.
Exactly.
PhD.
Because I actually, when I was at Columbia, I interned with Exxon.
Okay.
Arabs, engineers, oil. So they had this very interesting international management program. And they would choose 3 or 4 candidates across the whole U.S.
Yeah.
And they actually chose me at Columbia.
Okay. Interesting.
That was a very interesting experience. I don't want to get into details. Great company, but not for me.
Okay. And so, looking at your background, I'm seeing, private equity. I'm seeing you at this institutional banks. I'm seeing you having hedge fund experience. And then for a while, you were the CEO of Dubai Investment.
Dubai International Capital.
International Capital.
Which is the international investment arm of Dubai Holding.
Right. And you're investing in emerging markets, MENA, Turkey, a little bit in Asia and Latin America as well.
India, we looked at India. We did a couple of things in India also.
Okay. And then you form MEVP.
Well, not exactly. So when
walk me through this.
So, and again, the position at Dubai International Capital was also a bit of a, curveball because I had just gotten married and my wife and, my parents were getting a bit old because the plan was not to stay in the U.S. for 19 years. The plan was to stay in the U.S. for 4 years, get my PhD and go back home. And I think I felt that I need to come back home. And I had accepted the position with a big restructuring investment bank based in Los Angeles called Houlihan Lokey. This is one of the premier restructuring firms. Accepted the offer. They actually rented me a house. And then I changed my mind.
Oh, wow.
And basically came back to the region with no job prospects. And through a good friend of mine who had just moved to Dubai, I got connected with Dubai International Capital and became the CEO of emerging markets. Again, total serendipity.
Wow. And again, a reminder of...
And I didn't know, I knew Kuwait, I knew Lebanon, I knew Saudi Arabia. I had been only once to Dubai before. So this was not driven by Dubai. It was driven that I wanted to be in the region and it was an interesting job.
Interesting. Mm-hmm. And what made you pivot from that to... venture capital.
So as part of what I was doing, as you said, I covered emerging markets, but our key market was Middle East, North Africa, MENA. And to do proper PE, you need to have a pipeline of smaller companies. And there wasn't much. And we created at DIC something called the Arab Business Angels Network. Mm-hmm. This was the first formal angel investing platform in the region. And as part of that, to launch it, we did something called the Arab Angel Investment Competition. We marketed to very, very small companies across the region, got 2,000 applications, and worked with one of the accounting firms to weed them, to teach them how to do elevator pitches, a modicum of a financial model, etc. And then the top 50 presented to me. We chose 5. They came to Dubai. We did a big gala. The top 2 got each one almost $1 million. And then we launched this platform called the Arab Business Angels Network. When we translated angel back then, this was 2005, to Arabic, they thought we were a religious organization. It didn't ring very well. So actually the Arabic name talks about the entrepreneurs, not about the investors' angels. So it has a,
Is it still alive?
No. But it was the key platform, and then a lot of things morphed from it.
Okay.
You know how they talk about the PayPal mafia? Mm-hmm. Well, this is the A-Ban mafia, Arab business. Yeah.
The A-Ban mafia.
We can talk about a lot of people who sort of went out through that.
Okay.
And, I met with my partner, Walid Hanna, who back then was at Abrar. And he came in and he sort of managed and grew the Arab Business Angel Network.
Okay, so that's the start there.
And we had also 2 very small angel funds. One of them was a women-only angel fund back in 2006. Not a lot of people know about that.
And this angel fund, if you were building a pipeline for private equity, it wasn't just tech. It was
was everything.
Interesting. Okay.
It was everything. Tech was maybe half.
Fraction.
Yeah.
Okay. Interesting.
This started my next part of my career. So I had Melwood Capital, as we discussed earlier. Melwood Capital is a company I own. It's a merchant bank, so it's both basically advisory and capital, which is a very interesting way of doing things.
Based out of California?
Initially California, but it's me, so it moves with me. So.
Okay.
Yeah. I don't know if you remember, there was a very good U.S. firm called DLJ, Donald Lufkin and Jenrette.
Okay.
Very famous firm acquired by Credit Suisse eventually. This was like the classic merchant bank, American style. And I tried to model my tiny company on that premise.
Okay.
Because only advisory in the work does not work very well. People don't like to pay for advice because they know more than we do. But if you combine advice with capital, and that's what merchant banking is called, then people take you seriously because there's the advice arm and there's a principal arm.
Yep.
And this was the idea. So I focused on that. And
mostly non-tech sector.
Yes, non-tech. There wasn't that much tech.
Yeah.
Tech was too small for what I was focusing on.
And you were focused on the region.
Yes, but I mean global, but I go with my clients.
Okay.
You know. And then I think in 2009, Walid Hanna sort of contacted me. He told me, look, he had also left DIC by then. He said, look, I would like to morph this Arab Business Angels Network into a VC firm.
So that's the genesis story.
Yes, it was his idea. And I joined him as his chairman. You know, the old guys get the big titles.
Interesting.
And that's how it started. And then we raised our first fund in 2010.
Yeah. And you guys have, you know, different years, different numbers, but it looks like roughly, you know, about average 10 deals a year.
A bit less.
A bit less.
A bit less. Probably 6.
Okay.
And obviously it's not continuous, right?
Yeah.
Depends when you are in your investment period, etc.
And at the initial stages, obviously, I saw a lot of seed stage and whatnot.
Yes.
But lately, I've been seeing much more later stage.
Yes, because we've grown and evolved with the industry, with the maturity of the market. So when we launched our fund in 2010, MEVF, Middle East Venture Fund 1, if you want. We didn't call it 1 because we didn't know whether we were going to continue.
Right.
So it doesn't have a 1. That was a $10 million fund. Okay, this was the first, and maybe one of your listeners can correct me, but I believe it was the first GPLP structure, very American style GPLP structure in the region, $10 million. Now, you had to start in the seed first because the fund is small, and because there was no Series A's, no Series B's yet.
Yeah.
And we grew and started focusing on the later stage investments as the ecosystem grew.
Okay.
So our second fund did a bit of Series A's and seed. Our third fund did mostly Series A's. And our current fund does A's and B's.
And I imagine if you go back to the beginning of that, it was quite tough at the time to find strong startups to invest in, right?
Very tough.
You guys,
I mean, if you think the startups are dangerous, VC firms typically don't survive. There is a risk in VC firms called, team risk. People who can stay together for years, the early years when you're not making money. And we've had that stability at MEVP, which is very important.
It's lovely to see. I want to take a step back for a second before we go a little bit deeper into what you're doing at MEVP and the changes and the trends you've seen. But because you've had this experience with institutional banks, with venture capital, with hedge funds, et cetera, and private equity, I wonder if you can give our audience an understanding. I mean, some of our founders do come to us and say, should we be looking at PE or does PE just approach us? Can you give us a little bit of this overview of how, let's say later stage startups should start thinking about these different investor groups and even institutional banks? We're starting to see some debt financing now in the region. How do you approach that in that later stage when founders really only know angel and venture capital? What are all these other investors? How are they different from each other?
Okay. So the journey for a founder is to raise money until he exits. And typically you start raising money from initially your parents, then your friends, then hopefully an angel, somebody who likes you, who understands your sector, and who's in it not just for the money, but he adds a lot of value.
Yeah.
And then hopefully you end up getting money from institutional money, which is what we do at MEVP.
Yeah.
Right?
Start
Firms,
with the venture capital with higher risk appetite.
Yes. Now, all the stuff is under private equity because we're still investing in private companies. So VC is a subset of private equity at the end of the day. And then as you grow, you'll end up doing your Series A, your Series B, bigger funds, maybe international funds. We've done that at MEVP. We've actually been able to raise about $1.6 billion for our companies because our funds are not very large and the opportunity area actually is quite large. So you end up raising from us, from other funds, we bring in international funds. We also brought in some strategics, media groups like NBC is a big investor with us, some banks, some telcos, Zain, Mobile, Etisalat are investors with us. And this is as you mature.
Yeah.
And then you might move into private equity funds. And these are private equity funds that focus on growth. So you have a lot of funds in the US that do very large transactions in late-stage technology companies. So they're tech companies, but they're probably profitable.
Yeah.
And becomes sort of high-growth PE play without a lot of debt, because technology companies tend to not attract a lot of debt. So that's sort of the later stage. So if you look at a company called General Atlantic, for example, or Pacific TPG, Texas Pacific Group, they have a lot of product, but they have a couple of very important tech late-stage PE growth products. Okay.
And so PE have funded and acquired just that piece.
It's not clear how you transition.
Right.
At the end of the day, you're still investing in private equity companies, private companies, right? It's still private equity.
Yeah.
But it's later stage. And these are companies that can get you closer to your ultimate exit.
Do founders feel when they send, or from your perspective, when founders get a private equity that acquires them, I think there's a image out there that private equity tends to come in and then they replace management and then they put in like high growth KPIs.
Rarely.
And it feels like an exit.
Yeah, rarely in technology.
I see.
So private equity does something called leveraged buyouts. And leveraged buyouts can be done on public companies or on private companies. And there are things called management buyouts, where management wants a new type of shareholder. They go find a private equity firm that will go and buy their shareholders, but keep them to lead this new company. So there are a lot of variations on the same thing. So, but however, in technology, typically, they will not replace management because they are still, founder-led companies.
Yeah.
You might strengthen management. Maybe some CEOs have made enough money and have not grown with their companies. I mean, growth pains are difficult, right?
Yes.
Both for companies and for people.
And my impression is that for when private equity comes in, it's usually the private equity company that has found that player and made that connection. Do you see it the other way around?
Yes.
Where a founder will actively...
I haven't seen it here. I've seen it in the US.
Yeah.
We backed teams where management decided they wanted to grow much faster. Their existing shareholders were not ready. And this is not there's no animosity here, right?
Yeah.
They find a financial investor who will acquire their existing shareholders at a good price, and then fund the company more and hopefully accelerate their growth.
Interesting.
And these are called MBOs, management buyouts,
okay,
where management goes and finds a new investor.
Okay. And you're not seeing much of that yet here?
No, some of the companies here are still small. I'm sure there are some, but this is not what we focus on also.
Yeah.
Because we don't do buyouts, we only do growth capital.
Yeah. Okay. Fair. Fine. So let's talk about MEVP, 14 years old now. How many funds?
4 regional funds and 2 Lebanon-only funds.
2 Lebanon only?
Yes.
And have they been recent?
No.
Our
last Lebanese fund was from 2014 to 2021.
Okay. Because Lebanon's going through a difficult period.
Yes. But we were there earlier when Lebanon actually was still interesting.
Okay.
But we've always focused on our regional funds.
Yeah.
Our first fund, MEVF, was a regional fund.
And currently, which fund hasn't been fully deployed?
Okay. So our fourth fund, which is Middle East MEVF4, Middle East Venture Fund 4. There's a fund that we did the first closing in March of 2023.
Okay.
At $70 million, first closing. Target is $150 million.
Okay.
And we've invested already in 9 companies.
Okay. And sector agnostic?
Sector agnostic. When people ask me that, I tell them we invest in companies that make money.
Okay. Like a typical banker answer, right?
Well, but because there is no themes in VC, in my opinion.
Yeah. Well, particularly in this region.
Yes.
I would say in the US, there's definitely specialized funds.
Yes, much larger funds.
Yeah.
I mean, the US is the land of specialization. Here, is a land of jack of all trades.
And do you see that changing? And
it will change eventually as the region grows and matures.
Yeah.
But by our analysis, you need to give an institutional investment experience to your investors. We have institutions, right? We don't have people.
Yeah.
You need a big team. You need back office. You need accounting. You need legal. And you cannot do that if the fund is not at least $120 million. The cost of giving that institutional experience to your investors will be too much for a smaller fund. The funds in the US are much, much larger, and they can be specialized. And also the sectors in the region, other than fintech, are not very large. I mean, I think Venture Soup has a fintech fund.
And a sustainability or climate.
That's fine. We looked at those. We felt, and we like them. They've co-invested with us. We're good friends. But we felt that still fintech is not big enough to deploy $120, $130 million. This is our analysis. I respect what they're doing, of course.
Yeah.
And sector agnostic, yes. I mean, we don't do hardware. This is not Shenzhen, obviously.
Yeah.
Okay. Yeah. And also climate tech and EVs we don't do. We looked at some companies that use software to reduce energy consumption, etc.
Yeah.
But EVs, climate is very specific.
Okay.
Kleiner Perkins lost their shirts on their first, climate tech EV because they were, and I'm not dissing Kleiner. I mean, they're very important, but this was the first fund where they actually invested in regulated sectors. And
that comes with its own risk.
yes.
Yeah. Okay, well, let's focus on what is it that you are excited about? What are you investing in right now? And is it all later stage or
No.
A plus?
We do at the end of the day, if we find something outstanding, okay, we go through our investment committee, and then we have also LPAC. That means there's a committee of our LPs who can opine on things if we decide to stray a bit from the fairway of our fund. But typically what we do, our funds are 8-9 years long funds. The investment period is 4 to 5 years. Typically in the first year, we'll do some small early stage bets. The reason is we can hold them for 7 years and we'll have time to grow them. After that first year, we only do A's and B's. Okay. However, VC, you make money in VC on outliers. This is a bit of a conundrum. People talk about strategy. There's no strategy. No, it's true because the outliers. Look, if I understood the outlier, that means the outlier is not an outlier. It's a bit of a circular argument.
Yeah.
Right. And we want to make good bets with people we like in sectors we understand.
Yeah.
And then we're always surprised by
the one that stands out.
But that's why in the early stage, and look, A's, B's, this is still the early stage.
Yeah.
We still advocate a portfolio approach. Okay. We as partners and our employees have our money in our fund. So we're also taking exposure to 12 to 14 companies in a fund. This thing about I know it and I will focus only on one company is for us a bit dangerous. Especially,
and that is the VC model, right? It's make 100 bets and hope that one pays for all.
Yes. However, we don't do an American model. I'll explain to you why.
Okay.
In the US, you can lose 90% of your portfolio. And then one company does an IPO and you can return multiples of the funds.
Yeah.
We do not have that option here.
Yeah, explain that.
Okay. So our upside, short of an IPO, is probably a 5x, 6x. If your upside in a trade sale is a 5x, 6x, you cannot lose 90% of your portfolio. You never make money. It's just math. And people who don't understand that don't understand the business. So we take much less risk here than in the US.
And it's just because of the nascency of the markets or
everything.
Pure population
No.
macroeconomics?
The nascency of the market, the fact that IPOs are new. Okay. If we had to go to IPO market and banks can work with us on our small Ds to help us IPO, etc., we'd take more risk.
Okay. So let's jump into this IPO conversation. Saudi's done two, but on parallel.
Two technology companies. They've done a lot of IPOs.
On the parallel.
And the UAE has done a lot of IPOs.
Yeah, but zero technology IPOs in the UAE. In fact,
so far in the UAE, we'll see. G42 is doing some interesting things. We'll see if some things come out of G42.
Right.
But no sort of classic technology companies yet listed in the UAE, unfortunately.
Yeah. And we have Fowry in Egypt.
Fowry, old fintech company, not old, old by VC standards. Yes. I think Fowry IPO'd in 2019.
Yeah, 2018 or 19.
Yes, 18, 19.
Yeah.
So that was the first and only technology company listed for a long time. And then we had Jahiz, I believe, in January 2022.
20.
End of 21, early 22, just on that cusp.
Yeah.
And then recently we had, I think it's called Razan, a fintech company that listed last month.
Yes.
So we're still behind on technology listings.
And then we have all of these, mostly Dubai, but some of them are regional companies that move their headquarters to Dubai. And then they chose this SPAC model to then list on the New York Stock Exchange.
So let's talk about SPACs. This is interesting because we actually did one of the first SPACs out of the region.
Yeah.
We merged Anghami with the Nasdaq-listed SPAC.
Yeah.
Do you want me to explain what SPACs are quickly?
Yeah, sure.
Okay. So a SPAC basically is when you raise public money. So you IPO a company with a business plan to acquire a private company.
Mm-hmm.
Okay.
It's called the Specialized...
Special Purpose Acquisition Company.
Company, right. Okay.
SPAC.
Yeah.
Okay. Now, this is not new. People, there are ways in the U.S. to raise a public company that looks like a private equity fund, if you want.
Right.
So you raise the money based on people who know how to do investments, and then you give them time to do investments.
Right.
But SPAC took advantage of two things. First, it focused only on acquiring one company. This was not the fund. And also, there were some tax issues in the U.S., something called tax inversion. This is very complicated stuff. It's not very important, but the SPAC would get a relatively benign tax treatment if it acquired a private company that is at least twice as big as it is. So the SPAC shareholders had to be minorities in the merged company. Not of people know that, but that's what also fueled sometimes SPACs paying too much for the private companies. Because the valuation was not very important for them. They want to make sure that they don't own more than 35% of the combined company.
Right. Okay. But SPACs seem to have made a bit of a not great name for itself.
They have not done very well, unfortunately.
Why is that?
Well, because this was also when we had a lot of cheap money. This is when interest rates were also almost zero. And this is why people actually put money in SPACs. Because in a SPAC, you can put money in this IPO. And then you have a right, once the SPAC discloses what's the target company that they want to acquire, because they would require a shareholder vote, right? You could actually pull out of your money from the SPAC and get something called a warrant. So you'd get an option that has some value, but you would not expose your principal to the SPAC. And the reason this happened is people were getting basically zero interest rates in their bank accounts, or they were afraid also for some of the banks to go under. And this was their only option to get some time value of money.
Interesting.
By still having that option of pulling out if they don't like the target.
Interesting. That is a fascinating...
So SPACs, when they became very, very important, it was basically just because cost of capital in the U.S. went to zero.
But it does seem like a recipe for disaster and for greedy investors.
Yes,
to get
but not all of them. Some SPAC did well, but the majority did not do well.
Okay. Yeah, because we've got, I think Swivel was a good example.
Swivel and also Anghami, unfortunately. Anghami, SPACs typically in the U.S., they start trading at $10. This is sort of general for SPACs. So, Anghami today is trading at around $1, unfortunately. So we're down, Swivel is down probably a bit more than that.
And as one of the, interestingly, you guys as MEVP did invest in I always get their name wrong, Anghami.
We did the seed, the Series A, anchored the Series B, brought in NBC also.
Okay.
And then brought in Samina, brought in Mobile Ventures. I mean, Anghami has Do Telecom as an investor.
Yeah.
Anghami is a very important company in the Middle East. It also has a high profile.
For those who don't know, it's sort of the Spotify of the region.
Yes, we actually call Spotify the Anghami of the world.
Good branding.
So when we decided to do the SPAC transaction, we were just coming out of Corona. People sort of forget.
Yeah.
The IPO market in Saudi was not ready yet. This was like a year and a half before Jahez.
Okay.
So, and still, music was still not accepted in Saudi, if you want. I mean, Saudi has changed dramatically since.
Yes.
So we had no options. And we found this small SPAC listed on NASDAQ, Indian and Singaporean entrepreneurs who were looking to invest in a emerging market streaming business. It was like a match in heaven, right?
Wow.
First, because it was not very large, because if it's too large, Anami would not fit, and I would be too small. Remember, the target had to be 2/3 of the combined company.
Right.
So we found this company, $100 million SPAC, which is a tiny, tiny SPAC.
When you say we found this company, was that kind of under your remit as the chief exit officer?
No.
Is this part of your job description?
It is, but not directly here.
Okay.
So I meet with a lot of investment banks and market our companies, right? And tell them, this is what's happening, this is what's happening, this is what's happening. One of our investment banking partners was on a call with NASDAQ. NASDAQ, they do very well in marketing their companies. And they were marketing this company in the Middle East. Remember, you had NASDAQ Dubai, etc.
Yeah.
There was a very strong link between NASDAQ and Dubai. And this was a SPAC that was looking for an emerging market target. So there's no point of marketing it in the US.
Right.
And this banker heard that on the call, and he told me, and we gave them a mandate on the transaction.
Interesting. Yeah. Okay, so that's how you found it.
Yes,
so
but then I had to understand the SPAC, right? Yeah. Because it was very complicated, very new.
And walk us through this. So at the time, too, why, I assume that it's the same case now, but what did you guys look at listing on the Dubai Stock Exchange, or is that not a viable option?
No,
right now?
It was not viable back then. Again, remember, the decision on Alami was done in mid-2019. Okay? There were no IPOs yet here. And also, and still in Dubai and Abu Dhabi, these loss-making technology companies are not yet listable material, if you want.
Say more.
Well, the capital markets in the region are not mature enough. In the US, you can list money-losing technology companies because you can always find investors. It's a very big liquid market. You have investment banks, you have private equity firms, you have hedge funds. We don't have that specialization in the region.
You're saying the number of traders that are trading off these stock exchanges.
And the risk appetite, and people don't believe, at the end of the day, investors are correct. Yeah. They are the market, right?
Yeah.
They don't believe that they're going to end up with a Facebook, for example. Okay. And remember, we're all global investors. If they wanted the Facebook exposure, they can invest directly with Facebook on NASDAQ. It's maturity, but also there's a role, and Saudi is starting to do that, where the governments have to step in with this sort of founding capital and patient capital that will help a company go public. About 3-4 years ago, Abu Dhabi announced something called the Abu Dhabi IPO fund, if you remember, 5 billion dirhams.
What happened to that?
It morphed. I think it's part of ADQ or Lunate now.
Okay.
But one of our companies received some money from the fund to prepare to do IPO preparedness work.
Because it's quite expensive to get ready for an IPO.
It is expensive and complicated. You need a better CFO, a better legal. You might need to change your auditor.
Investment bankers are expensive.
Yes. So it is. It's a scale business.
Interesting. So this fund was sort of a bridge loan, a gift.
It was equity, but long-term risk equity.
Yeah.
And the idea was the company would list, and this money so this fund will not exit for like 2 to 3 years to stabilize the trading. Okay. It was a good idea. It didn't develop the same way, but there's always hope. I'm in VC. I'm always hopeful. Okay, it will happen eventually.
And do you think that we will see more technology companies listing, let's say in 5 years, in your glass ball?
We have to.
Yeah.
My children, who are 15, if I show them the stock market in the Middle East, they will not recognize any of the companies. They're, all children now are technology driven. And you want these future investors to invest in things they like. In addition, I believe in the Middle East, especially in the Gulf, we have a very healthy and growing technology ecosystem that's not reflected in our capital markets. And this is a lack of maturity, because typically your capital markets should reflect your real economy. So it will happen. It's lagging.
So it's just that on one hand, our startups are really not at that stage yet where they are that large and that mature. But secondly, would you say that there are some issues in terms of, I don't know, the process to list here in the region?
There are. Remember, the Arab world is more than 30 countries, different laws, different currencies. So, for example, in Saudi Arabia currently, you cannot list a company in Saudi unless the topco is headquartered in Saudi. They're working on changing that regulation. It's not easy. Now, the Saudis, there's something interesting in Saudi. They also have a small cap market called Numu. There's the big board, Tadawul, and Numu.
It's the parallel secondary.
Yes, which is like London Stock Exchange has the AIM. And we listed one of our companies, I'll talk about that, on the AIM last year. Small company, Lebanese team. Well? It's okay. It's not trading that much. It hasn't dropped because it has investors who are stuck in a tax scheme in the UK. You have to hold the equity for 3 years. And your tax rate is low.
I'm intrigued by this because, of course, 99% of all exits will always be some kind of buyout, right?
Exactly.
Like some kind of acquisition.
Of course, people forget that. The reason is people focus on IPOs because IPOs are public.
Somehow
and you hear
sexier.
No, but you hear about that. If I do a trade sale in one of our companies, the only people who will hear about it are my investors. If I list, the document is public. You can go look at the...
Right.
So even in PE... IPOs are probably 20% of the exits. 80% are still trade sales. Now, the reason you need an IPO is that when a company gets an offer to get acquired, it should have that IPO option to be able to negotiate better with the buyer and increase its pricing. In addition, having a local IPO market gives us local valuation multiples. How do you value these private companies?
Right.
What we do is usually we go look at multiples in India, China, and the US, takes discounts, etc., and apply them, and you end up with what I call a Franken valuation model. It'd be nice to see, Jahiz, Razan, Fawri, their multiples, and apply them to our companies.
Yeah.
So the IPO is a very healthy sign of maturity of the market. It will happen.
Okay, fair. So, but then if I'm a founder now and I'm in late stage and I'm thinking, I do want to have an IPO option, I'm getting the inference from you that they really don't have many options but to look at the New York Stock Exchange or the London Stock Exchange. But then when I think about that, I go, well, even if it gives you access to global investors, if most of them are regional companies, they're only going to attract regional or local investors?
I agree with
anyway.
you totally. Again, 5-6 years ago when SPACs became very prominent, everybody wanted to list in the US.
Yeah, what's
Chinese
the point?
companies? Well, it's a big market. It's liquid. You have the rule of law.
But if nobody knows you, if you're not an Amazon or a
agreed. But a lot of Chinese companies listed there, and nobody knew them.
Yeah,
and they were able to do well. Now the world has changed.
Yeah.
First, the US market has become a mega cap market.
So you have to be big.
Yeah, you have to be big. I mean, if you're below $1 billion, nobody cares.
Yeah.
Okay. This is one issue. But also, you're correct. People will pay higher value in markets where people know you. Okay. So the Chinese companies now are not, listing in the US anymore. They're looking at Singapore, Hong Kong, obviously, and maybe Saudi Arabia. Okay. So we need to list here. I agree with you. In addition, this is a very rich emerging market. People forget 50% of the risk when you invest in emerging markets, whether it's listed or private equity, is foreign currency risk. We have some key markets here like Saudi Arabia, UAE, Kuwait, Qatar, where we don't have foreign currency risk.
Yeah,
you do not find this. Yes, you do not find this in emerging markets. This removes at least 50% of your risk. So we have attributes here. However, individually, our countries, whether Saudi, UAE, etc., are not very large. So we try at MEVP to create something what we call MENA technology market leaders. We want to have scale by being number one in Dubai, number one in Abu Dhabi, number one in Saudi Arabia, and maybe number one in Egypt. Okay, to get that scale.
Yeah. Yeah, and that seems to be the playbook of the region, right? For startups to really start in the GCC.
Today, the markets in the US, whether NASDAQ or the New York Stock Exchange, are not ideal. And very few of the companies in the New York are big enough to be attractive. Now, so the world has changed towards us.
Yeah.
We have to just implement faster in the region to be able to list, $100 million company, $150 million company. not just wait until companies are mega companies.
Right. Okay. And so as I keep wanting to call you executive officer, but chief exit officer.
Chief exit officer, the abbreviation is CXO.
I love that. Okay. Yeah. But they use that also globally for chief experience officer.
And they use it as the number 2 person on a Navy ship.
Oh, do they?
Yes.
For coxswain.
Yes.
I love that. So as a chief exit officer, a CXO, are you speaking to all of basically the startups in your portfolio? Are they coming to you? And one question I often get is, when do you need to have some idea of what your exit strategy is? And is there a way to actually know that when you're starting?
Okay. So this is a very complicated question. And unfortunately, things change as you evolve in the relationship with our portfolio. Now, when we invest at MEVP, we only invest in companies where they sit in a reasonable market. We don't like very narrow companies. Okay. And typically there are other non-digital companies that look like them that might end up being acquisition partners if they disrupt them, etc. Mm-hmm. So we do this very early analysis to see if these companies can become real companies, if you want. Okay. Very specialized companies have a market in the US, not necessarily here yet.
It's too niche. And
it's too niche, and we're already having problems listing our regional leaders in our markets. Right. So if you go get a very niche, complicated player, it's going to be very difficult. Okay. So we invest in things where we can see their maturity, we can see how they would be important to the local market. Now, the exit story does not start, in year 7, right? It starts in year 1. And how does it start?
Does it start in year 1?
Yes, because you have to grow the company first.
Yes.
So part of my job is not just exiting, is attracting talent, attracting clients. Big clients can become your exit partners. Big clients can make you come into markets where you can find other exit partners. So there's a lot of work about growing this company, maturing the company, not necessarily on the technology part. That's the job of the founders, etc. But everything else. As
I'm hearing you speak, you're reminding me of your Ngami story, actually. Yes. Can you give that as an example with OSN? And because were they a customer first? No. They were always an investor.
No, OSN was not an investor.
No. Okay. So totally different.
But Ngami is a good case in terms of at least what we've done. So we invested with Eddie and Eli, the 2 founders, in their seed round. Mm-hmm. And then we did their A round, we led their B round, and then they connected with NBC. NBC came in and became a very important investor. Mm-hmm. We helped them with Mobile Ventures, with later Samina Capital invested. We also had Do Telecom invest in Anghami. So Anghami was growing fine, etc. And then Corona happened. Prior to Corona, we had given a mandate to JP Morgan to actually do a big fundraising for Anghami, $50 million. 30 million primary and 20 million secondary that would give us an exit for our early stage funds. And then Corona happened. And this was the JP Morgan team, the global JP Morgan team. The joke was, remember JP Morgan were leading the WeWork IPO. So Anghami was just after WeWork.
Oh dear.
Yeah. So we had this year and a half where nothing happened.
Okay.
And we had to find a solution for Anghami. And if we could have listed Anghami back in 2018-19 in Saudi, we'd have listed in Saudi. Saudi is one of our biggest markets. The biggest number of users comes from Saudi.
Today, but at the time, maybe not.
No, it was a very important market.
Okay. Yeah. Okay.
But Saudi things, from a culture perspective, it was not ready.
Yeah.
We had meetings with Tadawul about Anghami.
Okay.
And they would always tell us that, we're still not ready to list a music business.
Yeah.
And then we found the SPAC, and the SPAC sort of took a year and a half to close. It took a long time.
Yeah.
Today, if I want to list, I would list Anghami in Saudi Arabia, obviously. But it's always timing. People forget what was happening in between. So we listed Anghami. We were a bit late because the SPAC was very, very complicated. And we ended up listing once the SPAC market, unfortunately, started really dropping.
Yeah.
Okay. It's a timing issue. Timing is very important in life. And then Anghami sort of struggled because the stock didn't do well, and we wanted to raise more money. The SPAC also, we had a lot of redemptions. People pulled out from the SPAC, which is natural. So we did investment. There is a company called SRMG, public company in Saudi Arabia, big media company, great people. They invested with us in Anghami. And then we got approached by OSN. OSN, as you know, is the old cable network. It was a merger between Orbit and Showtime, if you remember. Okay, it became OSN.
Yeah.
And it's owned by a very large listed company in Kuwait called KIPCO. KIPCO is a big asset management business, and they own some industrial companies, and they owned OSN. OSN had, we knew OSN for a long time because they wanted to do something in streaming. They built initially a streaming platform called Wavo. I don't know if you remember. Anyway, we helped them with it. We streamed on Anghami Game of Thrones, I think season 6, because they own the HBO content.
Okay.
And very quickly we did much better than Wavo.
Interesting.
Okay.
That's what Game of Thrones does for you.
Yes. So they understood that Anghami was built very, very well to stream both music and video. Video is much more complicated. It's a bigger file, and the latency, you cannot have the video be out of sync with the so it's a much more difficult streaming load on your back end, on your hosting partner. But Anghami was built very, very well from the beginning. And then they in parallel, they created something called OSN Plus, which is basically the streaming app of OSN. And, it grew, but it's difficult for media companies to become technology companies.
Yeah.
People forget these are very, very different. OSN is good at buying content, curating artists, dealing with big PR firms.
Yeah.
But they were never designed to create technology platforms.
Yeah.
So we end up striking a deal with OSN where Anghami acquired OSN Plus.
Yeah, not the other way around.
Not the other way around.
Yeah.
And people talk about merger, etc.
Yeah.
It's not a merger, but it's fine. So Anghami is a public company, still a public company. Anghami acquired OSN Plus. OSN invested in Anghami, new money, to support the growth of Anghami and OSN Plus.
I see.
And as part of that investment, OSN owns now a controlling stake in Anghami, around 54%.
Yeah.
However, Anghami is still a public company.
Yeah.
Okay. And now it is the leading platform in the region that's offering both a music experience and a video experience. Okay. This is very unique.
Yeah.
It has its own challenges, but there are a lot of synergies, especially on your back end, your costs, etc. We announced a transaction in November and closed in, I believe, end of March.
Yeah, March,
and mostly
April.
because we were waiting for regulatory approval in Saudi and Kuwait.
Okay.
The deal was done, but you have to get regulatory approval.
Beautiful. Rabih, I feel like we could, I need to sit down with you for like 2 or 3 hours.
We can do another session, no problem.
We can always do another session. But before we leave, I want to ask the key question, and it's going to be a spitfire round in 30 seconds or less. What makes a perfect pitch for you personally right now as you're sitting in pitches? What advice?
Very simple. It's one of the big challenges is for us to understand the vision of the entrepreneur. He has to make us understand his vision. We see a lot of companies. So I don't care about the length, whether it's PowerPoint, Excel. He has to make us understand his vision. Once we share his vision, we'll understand this company, we'll value him correctly, and we'll support him correctly.
Beautiful.
Because remember, the entrepreneurs focus on one company. We're running 50 companies.
Right. Beautiful. Any last piece of advice or the best piece of advice that you've ever received that you want the world to know, and particularly founders?
Change is the only constant. Let me give you something a bit more apropos. So at MEVP, the reason we have this whole exit experience is that it's easier to invest, to buy than to sell. Okay. So when we invest through our fund, we're structured. We have an investment committee. We do all the right work. We follow companies for months before we invest with them. But then we are deciding to invest. It's our decision. Once we invest, it's difficult to sell because selling is somebody else's decision.
Right.
And if we don't sell, and this is a truism in VC and private equity, you don't give people their money back. They will not invest with you in your next fund. You have to close the virtuous circle of investing and exiting.
Yeah.
So we're probably the only VC firm that has this active exit team, because this is how you complete the virtuous circle of investing. Now, it's been difficult, even though we probably have done more exits than anybody else. But it's been very difficult and it's taken a long time. However, last year we were able to fully exit our first fund. Okay.
Beautiful.
Now, this took us 12 years, but fully exited. We did 2.5 times on the fund.
Excellent.
And we had a big exit earlier this year, a company called Fresha, that returned all of our second fund. So currently, we've returned 130% of our second fund.
Beautiful.
We have not exited all the companies, but third fund, we're looking at 2 exits right now, and our fourth fund, we're investing. So we talk, when I talk to our team at MEVP, I always tell them whether we're investing or exiting, you have to always be exiting.
Always be exiting.
Because if you don't exit, you have not really fulfilled the promise to your investors. Either you cannot sell it, so there's a problem with it, or it'll go bankrupt.
So if you take funding, always be exiting.
Yes, and when I sit with founders, and people forget that, we have a fiduciary to our investors, not to our founders.
Yeah.
We have a governance issue responsible to our founders if we sit on the board. But our final fiduciary is to our investors.
Just like startups have a fiduciary responsibility to you as the investor, you have your own investors to report to, as they probably to
And these investors have their money with us under our supervision for 7, 8, 9 years.
Yeah.
And they need to exit, and we need to give them good return.
Yeah.
Or else they will not come back. They will not invest in the IPOs and later if they don't have a good experience in the private market.
I think that's fantastic advice, Rabih, and great for startup founders to understand that, because often they just think it's a well of money that comes from somewhere. And, I think it's really important for founders to understand where this money comes from, what the responsibility is, and that is not just to you, but a whole bunch of stakeholders behind the investor as well.
And the more successes we have, the more we'll have more investors, and then we can offer the founders more money.
Beautiful. Rabih, thank you so much for being on the podcast.
Thank you for having me, Erica. This was very interesting. Thank you.
Great conversation.
Likewise.
Hey there. Thanks for joining this conversation. If you enjoyed that episode and you want to start researching potential investors for your startup's fundraising strategy, go to lucidityinsights.com and sign up now to the startup registration package by clicking the plans button on the top right corner. We look forward to having you join our future conversations and checking out our additional content. Until next time, stay hungry and stay humble.